All right, let's kick things off today with a bit of a riddle. I want you to ask yourself, what exactly connects a retail investing app that's famous for democratizing stock trading, a legacy global payments giant that's been around for decades, and a highly discussed crypto blockchain? On the surface, they operate in completely different lanes, right? But this week, they are absolutely intertwined by a single massive thread.
And that thread is big money, bigger stakes, and literally the reshaping of money as we know it. We are watching massive tectonic shifts happening right now in the global financial stack. It's honestly the exact same kind of high-stakes energy you'd see in a championship final, where everyone is picking a side and the foundational rules of the game are just being rewritten right before our eyes.
So welcome to The Explainer. Today, we're diving deep into a core theme, how the absolute foundations of global finance are evolving at lightning speed. We are totally moving away from an era of isolated financial tools and speculative crypto. Instead, we're entering this new reality of federally mandated infrastructures, preemptive defensive spending by legacy giants, and public blockchains acting as core institutional plumbing. By the end of our time together, you're going to see exactly how these totally disparate pieces fit perfectly into the new financial puzzle.
So here is our roadmap for today. 1. Robinhood's federal mandate. 2. Visa plays defense. And 3. Solana becomes core plumbing. Starting off with Section 1, Robinhood's federal mandate. To really grasp the massive scale of this shift, just look at this number, $1,000. On May 28th, the U.S. Treasury officially launched the new Trump Accounts app nationwide. And what this program does is provide a $1,000 federal seed starting on July 4th for eligible accounts. You guys, this isn't just some tiny pilot program. This is a national-scale wealth-building initiative rolled out by the government, and Robinhood is sitting right at the absolute center of it all. Let's break down the actual mechanics of these 530A tax-advantaged accounts. Because Robinhood didn't just casually partner on this, they literally built it from the ground up alongside BNY Mellon. They're serving as the official brokerage and initial trustee for an initiative that targets every single U.S. child born between 2025 and 2028. The app is actually live right now on iOS and Android, and the money hits in about 5 weeks. But that final point, that is the most telling. The SEC granted Robinhood a rare no-action relief from standard disclosure requirements just to streamline the onboarding. That specific regulatory carve-out signals exactly how seriously Washington is taking this rollout. Robinhood is building national-scale wealth infrastructure, basically by government contract.
Crucially, though, it's not just the government footing the bill here. Corporate America and massive billionaires are piling onto this infrastructure build. Sure, the U.S. government is doing the $1,000 seed, but major corporations like SoFi have actually pledged to match that deposit for their employees' kids. And tech billionaire Michael Dell, he just committed a staggering $6.25 billion to seed accounts for lower-income kids who might not qualify for the federal contribution. The market totally sees the value here, too. Robinhood's stock jumped 11.15% on Friday following this news. That's their best single-day move in months. And interestingly enough, it's entirely unrelated to crypto.
All right, moving right along to Section 2. Visa plays defense.
So Visa just dropped an announcement about a €500 million investment spread across European markets over the next decade. Now, at first glance, a €500 million sounds like this super aggressive expansion strategy, right? Targeting infrastructure, tech development, local innovation, all that good stuff. But to really grasp what's happening, we need to read between the lines of the press release.
The true why behind Visa's massive spending spree boils down to European payments sovereignty. In 2026, the whole debate around economic autonomy has intensely heated up. European policymakers are loudly pushing for homegrown alternatives, and they're rallying around projects like the European Payments Initiative. Why? To drastically reduce their reliance on U.S. networks like Visa and MasterCard. Basically, Europe wants to own its financial rails, and Visa is listening loud and clear. It is a classic case of corporate messaging versus strategic reality. On one hand, we have Visa Europe CEO Anthony Cahill's polished PR framing. He calls it an alignment with European priorities around payment resilience and highlights Visa's local processing and fraud prevention. He's trying to prove Visa contributes to the ecosystem rather than just extracting from it. But the reality? This €500 million commitment breaks down to roughly $50 million a year across a continent that processes trillions in annual card volume. It's preemptive insurance. Visa is essentially buying goodwill and regulatory runway, spending the cash now to ensure they literally don't get legislated out of the market later.
Which brings us to Section 3, Solana becomes core plumbing.
Let's look at how this builds a picture of true, hardcore adoption. Because these are not retail crypto milestones, these are institutional milestones. First up, SoFi launched SoFi USD. And listen, this isn't some experimental decentralized finance project. This is the first stablecoin issued by a U.S. nationally chartered bank. Built on BitGo's platform, it runs on an OCC-regulated bank's balance sheet and is redeemable one-to-one for U.S. dollars. How is this even legally possible? Well, the Genius Act gave banks the legislative runway they needed to do this on networks like Ethereum and Solana. At the exact same time, Cash App enabled USDC sends and receives across multiple networks. But the critical tie-in here? Both of these massive financial institutions are routing major portions of these features directly through the Solana network.
When you run the numbers on this adoption, the math is just staggering. You have SoFi with 15 million banking customers. You have Cash App with 59 million monthly transacting users. Combine those, and roughly 74 million mainstream consumers just gain seamless access to Solana-based stablecoin payments, sitting quietly right inside the apps they already trust and use every single day. I mean, they might not even know they're using blockchain. They just know their money moves instantly.
SoFi's Ben Reynolds put it incredibly plainly, and it is absolutely worth quoting directly. Solana is the right chain for payments because of cost, settlement speed, and throughput. This institutional validation is the ultimate proof that for major financial players, the whole Ethereum versus Solana debate for payments is effectively over. This isn't about reading complex white papers or chasing token hype anymore. It's strictly about superior, scalable back-end utility for heavily regulated institutions.
So let's bring all these tectonic shifts together and cover the big takeaways.
When we stack up the old world versus the new stack, the contrast is completely stark. The old world was defined by speculative, unregulated crypto, legacy payment giants just sitting comfortably without any real threat, and retail brokerages operating in their own little isolated bubbles. But the new stack we've explored today, it shows a completely different reality. Robinhood has officially locked in the next generation of American investors by acting as sovereign wealth tech through a literal federal mandate. Visa is aggressively deploying €500 million as defensive spending just to stay relevant in a Europe that wants autonomy. And Solana has undeniably crossed the threshold to become the undisputed, regulated blockchain plumbing for some of the biggest federally chartered consumer finance apps on the market today.
Which leaves us with a pretty critical question to ponder. As the foundational infrastructure of global money continues this crazy tectonic shift toward these new, agile, and heavily regulated frameworks, if your own financial institution is still comfortably running on the legacy systems of the past, exactly how long until they are permanently left in the dust? Keep a close eye on these stacks, you guys, because the game is fundamentally changed. Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.